And we now have Simplify as our co-host, and let's get started. All right, Jim. So you're joining us from Chicago, is that correct?
Yes, that is correct. It is 33 degrees.
33 degrees. It's not that much warmer here. It's 43 degrees in California, the Pacific, roughly the same temperature as the Pacific Ocean this time of year. But I assume that my pleas for sympathy of the dark and dismal nature of waking up in California falls on deaf ears for Chicago residents right now.
It does even in July.
Even well, at some point you'll have to come out. We'll go for a hike over the Marin Headlands. Well, listen,
It's a deal.
part of the reason why I wanted to reach out is that you put out what I thought was actually a fantastic tweet thread highlighting the discrepancy between what the market and what most strategists are seeing and what the Fed seems to be indicating through both its supplemental guidance in terms of the dot plot and its guidance in terms of expectations of terminal rates and what is being priced into the markets and the general acceptance of a recession, even as Powell asserts that we can still achieve a soft landing. I thought it was a great thread that kind of defines the difference between where you and I may see these things. And I wanted to discuss it more fully with you, both kind of sharing my objections to it and what I think is going on, and get your reaction to that, both in terms of where you think I might be wrong and what the implications are if you decide that I'm wrong or we conclude that the Fed is seeing the information set wrong, how that might change the outlook for 2023. Does that seem like a fair place to start?
Yeah, no, it definitely does, and you're correct. What Chairman Powell laid out last week, which if you put that tweet thread up in the nest, and it's the first chart there, is a completely different path than what the market is expecting right now.
So let's do that right now. Olga, who is operating the Simplify account for us, could you post into the nest the very first one of 22 charts that Jim has? You could probably just put his tweet into the nest. That would be acceptable. Okay, so what Powell laid out last week, it feels like forever ago, doesn't it?
Yeah.
What time flies when you're having fun. Um, was this idea that we're going to come in excess of 5% as a terminal rate, that there's plenty of hikes left ahead of us, and that the market has misinterpreted or is pricing in a series of cuts that they are unlikely to deliver. Now, my immediate response is, of course, is the same gentleman that assured us in 2021 they would not be raising rates for a long time to come, and that did not age well. I would interpret that similarly, but there's two things before we even get started on the likelihood of whether this is correct, incorrect. First, it's very clearly a statement of facts. But isn't it somewhat a requirement that if the Fed is indicating a pause, that the market has to actually price in a degree of cuts going forward simply because of the nature of a normal distribution? If they've defined that as effectively the top, by definition, the center of a distribution has to be lower than that. So the market may not actually, this is one of the ways I'm looking at it, the market is less so pricing in cuts per se, as much as saying, well, if you've told us this is a ceiling, then by definition, the distribution has to skew lower. What's your
Oh
reaction to
no,
that?
no, that's definitely correct. I mean, the market is the shape of the chart. For those of you looking at the chart, the blue line is what the Fed is outlining, what they think is going to happen, and the green and the orange line are the day of the Fed meeting and last Friday. It's essentially the same number today. What the market thinks. The shape of that chart has been correct in that eventually there will be some cuts. Now, whether those cuts start in June and wind up having the market go lower by the end of the year, or whether those cuts start in the second half of 24 or anywhere in between, I think that shape is going to be ultimately correct. It's just really the timing of it. And I might add that shape you see of the market cuts has been the case for pretty much all of 22, although it keeps revising it higher as the year goes on because it never seems to come to pass. But you're right that's probably part of a normal distribution in the way that you should expect it. My my contention or complaint with this chart is I think it reflects the market's thinking that growth is got a much higher weight than the Fed's thinking that is inflation has a much bigger weight. And I mean not more than 50% of growth, but I think the market's understating or underbelieving what the impact of inflation is. And Powell has made it clear that he's not even going to think about cutting until we have unmistakable signs that we're going to 2%. Not that inflation is peaked, because it already has peaked and it's coming down, and it already is coming down, but it's going to 2, not 3, not 4, but 2. Then he'll open the door for cuts. Where I quibble with this is the market thinks, oh, as soon as we get a bad payroll report, or as soon as some other weak economic data comes in, that's it. They're cutting. This whole episode is over. He's put a much higher bar on cutting than I think the market is believing right now.
So this is one of the things that I think I disagree with, right? Because I'm not, when I look at that distribution, that's part of the reason why I highlight the way that I'm looking at it. I actually don't think the market is necessarily saying that they're going to immediately cut. I do agree that that is actually the narrative that people are using to explain the shape of this distribution, which, as I articulated before, is like it's really just the math of an option distribution, right? It doesn't necessarily indicate that the market is applying a degree of sentience to it and saying we disagree with Chairman Powell, right? But I do think that that is the narrative, and more concerning to me is I actually think that that's what Powell thinks the narrative is. That he looks at the market as basically an affront to his manhood in this dynamic, right? We'll show them that they don't control this process. What's your reaction to that? Do you think that there's an emotional component that is increasingly vested in here?
Oh, absolutely. And it was no more laid out than the 8-minute speech he gave at Jackson
I
Hole.
totally agree.
Which I've affectionately called "and the horse you rode in on" speech, because he basically went right after the market's expectations that the Fed was going to pivot and that they were going to be cutting rates. He views Fed credibility as being very important. He believes that one of the ways he can slow the economy he believes one of the ways he can slow the economy without creating massive job loss is through a reverse wealth effect. He needs stockholders and asset holders to lose some money and to pare back on their spending, less demand to bring down prices. So whenever, or the euphemism they use for that is tightening financial conditions. So whenever financial conditions loosen, stock market goes up, he's afraid that that will unleash animal spirits and get people excited to go out and spend. And that's why he keeps knocking it down. He did that, like I said, at Jackson Hole. And that was also the case at his November 3rd press conference, where he was very, very hawkish in attacking that argument. Less so in the one last week, but he did a little bit of that too.
Um, okay, so now it feels like we've established a degree of baseline here, right? That the market is pricing or appears to be pricing something. The Fed is interpreting it one way. Um, yeah, as I said, much less a mathematical relationship, much more of an assertion of, well, we have to show them who's boss. Um, and then there's the question of what does the actual underlying data show? And so part of what I reacted to you in our messages around your tweet thread afterwards is the dynamic of, is the economy actually weakening or not? And one of the charts that you highlighted in your discussion, and by the way, I encourage people to read the thread in its entirety because it is actually an excellent thread, and it's a wonderful statement of kind of the facts that appear to be on the ground. I think where I disagree with it is when I dig into what underpins that data, and in particular, I would highlight the tweet that I'm just about to retweet right now, looking at the dynamics of whether the job market is actually weakening or not. And if we put that into the nest and we just examine it, this is looking at the dynamics of unemployment claims, which are remarkably weak relative weak, meaning strong, right? Low levels of unemployment claims relative to what we would expect with the onset of a recession. They have risen, but they're still at a very, very low level. And I just want to get your interpretation of these events relative to this idea that is very much embedded in forward expectations of a recession. Why are we not seeing the jump in unemployment claims?
Yeah, just before I go there, I want to just make sure that Chairman Powell has said on a couple of occasions that these are my words, they're basically done trying to forecast a lot of this stuff, that they're going to wait until they see unmistakable signs that the labor market is weakening before they were to react to it. Not that all the leading indicators or all the accepted forecasts tell us that it's going to slow. And to that end, initial claims is a big number that they tend to focus on, and there's a couple of others we'll probably get to in a second. This number is very low right now on the initial claims front, down around 211,000 or so. That is historically, especially given that for those of you that are not familiar with the series, just real quick, it is a state-run insurance program. Each state runs their own insurance program. Each state reports the number of people that filed for a new claim. So you recently got unemployed, like in the last week, and you went and you online or you went to the unemployment office and you filed to get your unemployment insurance that week. The BLS, the Bureau of Labor Statistics, takes all 50 states, aggregates them together, and then they apply a seasonal adjustment to it because there is a lot of seasonality in the data. But that's all they do. They just pass along all the individual state data. So at 211,000, this number is very low right now. It is largely considered to be either a coincident or leading indicator of the jobs market because it's high frequency, comes in every week, and it's only a week delayed. And on the face of it, and as the way that the Fed looks at the labor market, this is an important indicator. Joe Weisenthal once called it the beautiful indicator, suggesting how great it was at predicting the state of the labor market. He was correct and may still be correct on that when he called it that. And so at 211,000, it is not giving you any kind of even an amber light, let alone a red light, about the state of the labor market right now. It seems to be, by this measure, to be okay.
So I just tweeted a response to that because this is one of the things that I'm seeing consistently across the data that the Fed is reacting to. And you did an amazing job of describing exactly the BLS methodology, which is to aggregate the information that comes from the individual states. Um, there's two challenges associated with this type of data. One is that claims are only a function of who is eligible, and therefore there can be outside influences, one of those being the frequency of which you claim. So you are limited in terms of your ability to claim for a period of time, and then you are ineligible to claim once you've exceeded that level. You may remember the 99 weeks, for example, in 2008
Mhm.
through 2013 that extended the amount of time that people were able to enter into their claims. When you have recessions kind of in near proximity to each other, one of the risks that you have is those who have recently been unemployed have effectively not been employed long enough to reclaim, to refile. The second component is particularly around the dynamics of COVID, when checks were basically sent out to anyone who managed to scribble their name in crayon onto a form. You had an extraordinary amount of fraud. And so you've had two events conspire. One is the number of people who are eligible to refile and a crackdown on quote unquote fraud is, in my analysis, artificially suppressing these levels of claims. And we see that first in the number of people that are eligible to file, according to the states themselves, right? There's been roughly 2 million people reduced relative to the pre-pandemic era that are eligible to file now. Ironically, because those people have exhibited unemployment in the past, they're actually telling us that those are the most cyclical and exposed to subsequent recessions. If you have claims of unemployment, you're more likely to be, a repeat offender. It's a terrible use of the phrase, but your incidence of unemployment, it tends to be concentrated within a group of individuals who repeatedly experience unemployment claims. So one of the things that I think is actually keeping it low is actually the capability of people to file for unemployment and the acceptance of those claims by the state offices themselves. What's your reaction to that?
I agree. I agree that, there is a limit. You cannot get unemployment insurance forever if you lose your job. And a lot of people burn through a lot of that, let's say, legally or correctly during the 2021 period when there was a high degree of unemployment and they're not eligible to refile. I might also throw in a third factor there too. These are state programs, and state legislatures and governors can change these programs at any moment to make it either easier or harder to file for claims, and they constantly do that. So these programs undergo what you would call a series break all the time on the state by state level. That said, uh, I don't think that that is an order of magnitude issue. I think, in other words, if people had not burned up all of their eligibility for unemployment, that we would be at 500,000 or 600,000 or some three times where we are now. We might be at a higher level because there probably are people that would like to continue to get unemployment because they're not getting a job or haven't gotten a job maybe all the way back to 2020, but ran out. But I don't think it's a big number. And if you were to look at the unemployment claims numbers and say, when does it start giving you a recessionary reading? I think it's got to double from the level that we're at now, maybe north of 400,000 before you'd start to say, yeah, this is something that is concerning. And again, I'm looking at this from the point of view of the Fed because that's ultimately where I think we want to go with a lot of this stuff. Is that you and me can agree or disagree on what the data says, but what we really want to do is get in the mind of Jay Powell and say, how's he going to react to it? Because that's ultimately what investors want to know and what could drive the market. So yeah, I agree that this might be understated, but is it understated enough that you could say that the labor market by the claims data is actually weak? And I'd say no, or at best, you'd say it's inconclusive.
So that I think is where I disagree. So first I disagree. I think that it is actually quite conclusive that we're looking at a data issue here, and more importantly, I agree with your statement that it's not just what we think. And again, you and I are free to disagree on these things. You'll be wrong, but that's okay. I'm teasing. The the question for me actually is, what if Powell is wrong? And that's really the interesting question because I actually agree with you. I think that Powell thinks he knows what he's doing. I think his degree of confidence and his desire to show the markets that the Fed has withdrawn the put, that the destruction of wealth is a positive objective for some bizarre reason, right? Um, and the question is what if he's operating, driving the car with a rear view mirror? What are the implications of that for markets? Is it worse than simply targeting the wealth channel? Is there a risk that he causes something to break because he's so focused on the rearview mirror he doesn't see the Mack truck in front of him?
Oh, there's definitely that is a huge risk. And just real quick on your thing that this is about Paul, I'd also like to add in here too that this is really about Powell
Totally agree.
because
Yeah.
there's a lot of evidence that there are other members of the FOMC, Mary Daly, Lael Brainerd, Charlie Evans, who's going to be leaving the Chicago Fed next month, just to name three, who vehemently disagree with the current policy. But the way that the Fed works is it's a benevolent dictatorship, and the Fed chairman gets what the Fed chairman wants. Now, in fairness to Powell, there's others on his side. Governor Chris Waller, maybe St. Louis President Jim Bullard, more aligned with what he is thinking. But you're correct. If he is wrong on this, he will have unnecessarily damaged the economy because of fighting an inflation problem that would not have existed. And so this is a high stakes game. And I think that this high stakes game has been showing up in the way that the markets are trading. As we sit here and talk, it's a Wednesday. The stock market is up 1% today. I'm old enough, Mike, you're old enough to remember 2019 when 1% used to be kind of a noteworthy move in the stock market. Now it's just Wednesday. And part of the reason I think we've got this heightened volatility, realized volatility to be exact, is because of all of this uncertainty. And a big part of that is what if he's wrong? What if he's right? And that inflation is a bigger issue. And that's why I think you see the markets reacting the way that they are.
So this is so again, this is kind of one of these interesting things. And I put this out in the tier one note this morning, um, and highlighted that one of the theories or one of the implications of the theories that you've heard me talk about around passive markets is this dynamic of increased inelasticity. Um, 2022 has been fascinating, and actually, let me post that chart into the tweets because uh, it's actually worth highlighting. This is actually a really cool chart. Give me 1 second here. We're looking here at the distribution of returns for 2022 versus 2000. And I've got 4 lines on here that I just want to very quickly explain. Um, the solid lines are the theoretical model that should exist under normal conditions, given the dynamics of passive growth. And as you, I know you're familiar with some of my work in this area, but probably it's not an area of focus for you, for very obvious reasons. You don't have to spend your time paying attention to what I'm talking about. When you have a market that is transitioning to passive ownership, you effectively have a market that has an upward drift to it because you are replacing investors who have a propensity to buy based on, their view of valuation, their view of a forward expectation, et cetera. When that money flows into passive vehicles, which is where it all flows to now, all they do is buy, right? Did you give me cash? If so, then buy. That creates a drift in the market that changes the distribution of returns over time. And one of the really remarkable things about 2022 is despite the fact that the aggregate returns were roughly double the losses that we experienced in 2000. Remember that 2000 was defined by both up and down through March, basically. It really didn't start to fall until September. But what's so fascinating to me is that we've managed to have more than double or roughly double the decline in price. So 2000, we fell by 10%. 2022, we fallen by roughly 20% before today, obviously. And yet the distribution is indeed shifted to that right. What hasn't happened in 2022 is the eye-catching market crash, right? The stuff that kind of gets the Fed to say, what the hell was that? Like, should we pay attention to this? Do we need to react to this information set? If anything, we've actually seen more reactions, as you're pointing out, with the 1% gain. The rigidities of the market, if the bears hesitate, pause, call into question anything, and are unwilling to increase their selling, the underlying flow of the market can create conditions under which it pops. And I think that's exactly what we're seeing, just over and over and over again. This is a mechanical process that's created by an increasingly inelastic market. I mean, it's a remarkable
Isn't it all?
distribution when you think about it.
Yeah, isn't it also an inelastic process as well too? The way I've explained it is a lot of this passive money. Bloomberg has an interesting breakdown of ETF
Yep.
flows where they break it down between the traders and the
Buy and hold, yeah.
the active, yeah, and the buy and hold crowd. And what people have to understand about the buy and hold crowd is they don't talk to wealth managers or they don't talk to advisors about what to do with their money. They talk to the HR department. And the HR department gives them a form, and then they check off that they're going to put their money in the Vanguard Index Fund, in the Vanguard Bond Fund, and no one advises them on their money. And if they watch the market go down and they decide that they want to get out of the market, they have to call the HR department and say, can I have an updated form so I can change my weightings? Very few people do that.
Yeah.
And that's why that money just keeps rolling and rolling and rolling. And it doesn't matter if the market is crashing or soaring or anywhere in between. It doesn't
Yeah.
change. Would you would agree with that? That's a big driver of this money.
I think so. I actually think it's slightly worse than that, right? So one, you don't need to, starting in
Mhm.
2006, you no longer need to request that form. 401k participation moved from opt-in, where I need to decide I'm going to participate in 401ks, to opt-out, where I need to decide I'm not going to participate. Prior to 2006, you had to make a selection or you went into money market funds. Post 2006, the designation of what's called a qualified default investment alternative, QDIA, was implemented, and now the HR manager selects for you an automatic allocation. Initially, that would be a balanced fund like the PIMCO Total Return, which is part of what powered the growth of those types of vehicles. Increasingly, that's moved to target date funds. And exactly as you described, the vast majority of people, particularly in target date funds, never stop to question their allocation, right? It's just remarkably stable. It's remarkably concentrated. The most of the estimates that I'm seeing suggest that Vanguard's incremental market share of each incremental dollar that is now going into a 401k is approaching 65%. About 90% of that is going into target date funds.
And target date funds have what, north of $1 trillion of assets? It's like the biggest sector of the ETF market that almost gets no discussion. I mean, we want to discuss every little nuance in what SPY is doing, but we never really discuss, the flows in these target date funds because it is constant and it is huge from what I've seen as well too.
Yeah, it's actually approaching $4 trillion, not $1 trillion.
Okay,
And it's interestingly enough,
what's a couple
it was
trillion
a couple
among
trillion
friends,
amongst
right?
friends, exactly. And it's increasingly concentrated, or I'm sorry, not increasingly, it is concentrated actually in mutual funds. So things like the Bloomberg monitor that I have on my screen, by the way, I agree for those who want to spend $27,000 a year buying overpriced data, Bloomberg is essential and they do a wonderful job of providing all sorts of value added insights like you were just describing. But that fails to capture the dynamics of mutual funds. Mutual funds in aggregate are experiencing significant outflows in favor of ETFs. And part of what's actually happening there, this is the great irony, is that as the baby boomers approach retirement, the mutual funds that they bought during their working years are now being liquidated. The active managers that they had hired and attempted to select, despite the underperformance of those managers, they held on to them. They're now liquidating those, and the excess is being piled into ETFs because they're more tax efficient outside of a 401k. ETFs broadly are not used within 401ks, although they're starting to be more and more. So we're creating conditions under which all of this is happening beneath the surface, and I would suggest that that's exactly what we're seeing in this changing distribution. The big bogey, the real question becomes what happens when eventually those passive vehicles get sold on net. And that's the nightmare scenario that people hear me talk about all the time. But I don't want to spend too much time on that because let's focus on the economic outlook. Um, when I look at that data on the flows, right, and I posted this tweet a few minutes ago, there's two ways that we can actually obtain that data. One is through the unemployment claims that's aggregated by the states. The second is through the BLS's survey and the household survey, right, where we track the flows. And this is, again, one of these really interesting things where if I look at those dynamics, I actually see the increase in the flows that are coming through in the household survey. I see an increasing number of people designating themselves employment or not in the labor force to unemployment status. That doesn't affect the claims data at all because it's not coming through the states as you articulated it. It doesn't fall into that category. But it appears that the data is actually very clear from the survey that at least as Americans themselves classify themselves, they're increasingly unemployed. What's your reaction to that? And by the way, we saw the same thing happen in 2013 when we removed the to 99-week designation.
Yeah. So just for everybody, the way that they calculate the unemployment rate, the way they would calculate the payroll report is done by two different surveys. One is done by households, and the Census Department does that, and the other one is done of businesses, which the BLS does. And on the business side, which is the payroll report, which we all find, more than half of that basically payroll providers and large companies will allow the BLS to get a copy of their payroll reports, not your name or my name specifically, but metadata of it. How many people do you employ, and various other metadata about that. So it goes to them. The household survey done by the Census Bureau is what you would imagine it would be. It's basically a survey where they ask you, are you employed? Have you been looking for a job in the last 30 days? The household survey is where the unemployment rate is calculated, because companies can't tell us who's unemployed. They can only tell us who's employed. That's where they get the payroll report from. There's a big spread now between the two. The payroll report, or the establishment report as it's referred to, showing businesses have been hiring a lot lately, as that has been going up by a couple of million. At the same time, the household survey has been relatively flat. There's now what happens too is that there is next level data that is released on a delay, and that came out in November for the second quarter. And that is like at a county by county level of the payroll report, who's hiring who. And when we look at that next level data, the Philadelphia Federal Reserve did a study of that and thinks that there's going to be a massive downward revision to the second quarter payroll report, which in the second quarter, it showed that over 1 million people got jobs, and that we might be down to 10,000 people have gotten jobs. Now, what does all this mean for the Fed? Because what it sounds like I said, and I did, is a lot of this data is a lot weaker than you would imply, at least at the top level. The Fed is focused on wage growth. That Chairman Powell, if I was to channel my inner Powell, it would say, you might be right, and that data might be slowing down, but average hourly earnings and employment compensation are showing that in wage growth is still around 5% a year. If you go to the Atlanta Fed website, they do the wage tracker. It's more like 7+% for people that switch jobs, and it's more like 4-ish for people that keep their jobs. Your increase in your wages. Remember, a lot more people keep their jobs than switch jobs, which is why those numbers are not symmetrical, around 5%. And so Powell's argument to all of this would be 5% wage growth means you and I and everybody else can pay 5% inflation. We can increase prices by 5%, and your real purchasing power is unchanged. That ultimately, if the labor market is weakening by all this data that we've suggested, it is not weakening enough to see wage increases fall back down to a 2% range, where you could say, if you could afford 2%, you can afford 2% inflation. Okay, that's our target. And to that end, he has also come up with a new metric that he's been promoting for the last month or two, which is services X shelter, where he looks at the core inflation rate and he looks at just services inflation, and he removes OER and all the shelter components. And that's been rising at around a 7% range, but it's been coming down like overall inflation. And he says the problem with services X shelter, it's over half of core inflation, 55% is the number he gave. And the reason I say that is it's not a number that you can go to your Bloomberg, or I can go to my Bloomberg, or you go to the BLS site and go, where's that services X shelter metric? That's something the Fed made up, is what it is. And it's 55% of core. And he says that is driven by wage growth. And if wage growth is at 5%, then 55% of core inflation is going to stay around 5%. And we cannot achieve 2% inflation, hence his hawkishness.
Yeah, and
Hopefully
so
that wasn't too much.
no, no, no. I mean, that's the whole point of is you and I are going to operate using the language and terminology that we do, and we're dragging everybody else along. So we'll break it down as we can. Let me split that into two separate components. So one is this issue of revisions, right? And One interpretation of that is, oh, well, that's factual, right? The revisions are factual. The second interpretation is, well, the revisions themselves have revisions and we're uncertain around it. The methodology of the Philadelphia Fed, to a certain extent, by the BLS in aggregate, whether they should choose to move to a more real-time approach to reporting those revisions. And the conclusions were that they were uncertain in terms of their implications. Um, I tend to favor the Philadelphia Fed interpretation of events because of the tweet that I'm putting out right now. And and again, this is a point of reasonable disagreement, right? Um, the Fed changed its methodology, not the Fed, I'm sorry, the BLS changed its methodology in 1999 to incorporate something that's called the birth death model. Historically, revisions to payrolls were inevitably upward because you failed to capture new businesses being formed that did not yet become part of the survey. And so in 1999, particularly with the dynamics around the entrepreneurship of the dot-com cycle, the Fed found, or the BLS, I keep screwing this up, BLS found it appropriate to include an estimate of that rate of growth, right? What they refer to as the birth death model. And I just want to caution people, you can find this data from the BLS. Do not attempt to add it to the NFP data or subtract it from the NFP data. You have to go through a process of using the non-seasonally adjusted data and adjusting it in that framework before you these conclusions. So I just want to caution people, it's not as simple as saying a huge birth death number or a very low birth death number. But what has happened is that the birth death number has driven behavior because of how it's constructed, that revisions around downturns are inevitably to the downside, right? We've created conditions where we're using a linear regression that has certain characteristics, and I would argue those characteristics have been exacerbated in the post-COVID era. The most important thing to remember about what's happening with birth death is the BLS, in its survey of establishments, now assumes that establishments that don't report have the same rate of growth as businesses that do report. Now, there's an obvious flaw in that methodology when businesses start to close down, go bankrupt, et cetera. They're not reporting not because they just failed to do so, they cease to exist. And you're only going to capture that in the revisions at a later date. Hence my emphasis on the Philadelphia Fed. You can actually see this in the data. If you look at the revisions post the introduction of the birth death model, recessions result in negative revisions to payrolls, whereas prior to that, they were largely positive. So somebody using the full data set is going to say recessions really don't have any signals to them, right? We saw this in a discussion that was introduced by a Twitter personality who tried to highlight that revisions don't really mean anything. That's just untrue in a post-birth death model. Jim, do you have any reaction to that?
Yeah. A couple of things about the birth death model. I think it's important for everybody to understand that the majority of people in the United States work for a company of less than 100 employees. Bianco Research, my affiliate company, Arbor Research, in aggregates less than 100 employees. Mike, I
Same
believe,
for mine.
simplifies less
Right.
than 100 employees too, isn't it?
Yeah.
So you have
Correct.
to incorporate something like a birth death model because that's where all the job growth is. As a matter of fact, the BLS has done studies, and if you look at companies that employ more than 1,000 people, their net job increase over the last 30 or 40 years has been zero, because when you get north of 1,000 people or north of 5,000 people in your job, you're basically into productivity. You're trying to hire computers and robots to replace people and not expand your workforce. So it's important that we try to have a methodology to try and capture new business formations, because that's really where the job growth is. Now I've said that, there's another thing about new business formations. There is a series called New Business Formations. You can look at that separate from the birth death model. And what's interesting about that is if you go back 30 or 40 years ago and you look at where were half of the jobs created in the United States, you could identify about 300 counties out of 3,000 plus in the United States that created about half the jobs, largely large metropolitan areas, but spread out all over the country. And pre-pandemic, it was down to 20 counties because a lot of new jobs are in one industry. They were in tech. So it was Kings and Queens in New York. It was Cook County in Chicago. It was Marin County. It was Silicon Valley. That's really where a lot of the job growth is right now. There isn't a lot of people in Grand Island, Nebraska, or Akron, Ohio, creating a lot of new jobs, hiring new people like there would be, say, in Silicon Valley. So what that means is that job create or new business formation is highly concentrated, and it could be a lot more volatile than it has been in the past because it's so dependent on a couple of industries. And by the way, who's laying off like crazy right now is the tech industry. So what you're going to probably see along with birth death is a lot of revisions because it's who is creating new, every day somebody's creating a car wash, every day somebody's creating a restaurant, and they're going to be hiring people. So there's that. But when you're talking about businesses that will prop up out of nowhere to employ hundreds of people, in a short period of time, those are almost always somewhere in the tech area, and that's going to create a tremendous amount of volatility when it comes to the birth death model.
Sorry, I just realized I had muted myself so you didn't hear me pouring a cup of coffee. Um, yeah, no, so I agree. I think this is one of the really interesting challenges is that we're experiencing a radical change in the structure of job creation. And um, certainly since 2000, when we had the dot-com bubble bust, this is the first cycle in which it feels like Silicon Valley is meaningfully affected. The traditional job growth areas and the flyover, ex flyover states are experiencing more hardship. And in many cases, I would suggest that the bad governance habits that have emerged in these states are likely to lead to some real challenges. There's also just the broader model, right, that I would suggest took hold in places like Silicon Valley, which is not to build sustainable businesses based on profitability and internal cash flow, but rather to rapidly scale on the back of venture capital investments to get to the point that you're perceived as representing a threat to the monopolies of Google, Microsoft, Apple, et cetera, and position yourself for sale to those companies, right? The statistics are pretty staggering when you look at the number of acquisitions that Google, for example, has made over the last decade. I believe the number is approaching the 1,500 separate acquisitions that it's made. We call them everything from acqui-hires to, basically blackmail money. That certainly seems to be the one of the key drivers of the gravy train of Silicon Valley, right? You build businesses that have no real reason to exist other than to potentially threaten disruption, not real disruption. Just we're going to steal a segment of the advertising market from Google, et cetera. Um, that does feel like that is at risk from two fronts. One is the cost of financing for many of these companies suddenly, instead of needing to turn to alternative assets, things like venture capital or private equity, to capture returns based on some historical model, you now actually have a plausible alternative in risk-free treasuries and high-grade corporate bonds in terms of the excess returns that are available in those spaces thanks to the Fed. You also have the kind of secondary issue, which is increased scrutiny coming from this administration in terms of antitrust behavior. It does feel like something significant has changed there.
You know, a quick comment on that. I'm going to say the triggering word for everybody, Elon Musk here.
Yep,
And
agree.
he fired over half of Twitter's staff. And there was some talk about a couple of weeks ago when that happened. People were saying goodbye to each other on Twitter because the app was going to stop working. And here we are in a Spaces a month later, and it continues to work. But I think that there's a broader implication for all of
Jim,
Silicon
Jim, I'm sorry, I
Valley.
can't hear you. I think Better Twitter Spaces just shut down. No, I'm
Oh
joking.
no.
I'm totally serious. Totally joking. Go ahead.
Yeah. No, but I was going to say there's a broader implication for all of Silicon Valley and stuff. Is that the dirty little secret is, look, he got rid of half the staff, and the company operates just fine. If we're a Silicon Valley firm, could we get rid of half the people that work here and continue to be just fine? And the answer largely is yes. You're right. They all overhired. They all looking to sell themselves to be, 1501 to Google, and they all have way more people than they need, and they could get away with it because of all of the VC money and the mentality and the lack of pressure to be profitable, but to scale. And if that is changing, there's going to be huge turnover when it comes to tech related jobs because the mentality and the reason that we want people in a tech business is going to change than it has right now.
Yeah, I actually do think that what has happened with Elon Musk is a really important cultural development where the capital owners, in Jack Dorsey would be the extreme version of this, have suddenly recognized that their utopian visions, right? This is late 19th century sort of stuff where factory owners briefly flirted with the idea of communist style utopianism. Let's go build a factory and let's have, everybody in the community working together. We're all going to participate. Just turned out to be an epic disaster, right? The consequences of that were many communities that were founded and then subsequently abandoned. I'd suggest that there's that type of behavior often online, where online communities get created with the hope of creating profits and then abandoned. Um, Now we're probably seeing an element of the reassertion, or at least the attempted reassertion of control by the capital owners, saying we need to instill discipline and make these, workers work much harder. Um, Perhaps you could draw analogies to the corporate raiders of the 1980s, who ostensibly were cutting out the fat that had built up during the period of the management control in the 1950s, et cetera. Right? Um, it definitely feels like something like that is in play. It's unclear to me, interestingly enough, how that plays out, because what we are clearly seeing is a very structural change where the shortage is largely a function of a shortage of workers, particularly at the lower end. I'm not going to have time to I might be able to find the chart and put it up, but there's been a very structural change in supply of labor in the US economy, where the growth of the labor force of those with college degrees has exploded. The growth of the labor force of those with less than a college degree that we would traditionally associate with trades or quote unquote non-information workers, right? Construction, plumbing, driving vehicles, etc. Manual labor has collapsed alongside a dramatic decrease in the availability of immigration. Right. That may start to change, by the way. Just to be very clear, like there is evidence of a increased wave of immigration attempting to come into the United States at this point in time that may begin to address some of those things. But everything ranging from Chinese workers to H-1B visas to um, immigrants from Southern North America, Central America, et cetera, those have all declined dramatically, creating shortages. And this goes back to your observation about the Atlanta Fed, for example, creating shortages of workers that are willing to get their hands dirty, have exposure to COVID, change bedpans for the elderly, et cetera. There's a shortage of those workers and an explosion, or a relative explosion, of workers who believe that they should be sitting at a desk, analyzing data, enjoying the company buffet, et cetera. This is a very clear shift that, in my opinion, is the unfortunate byproduct of the credentialization of America, where we send people off to college to quote unquote get a college degree as compared to actually learn how to do something with that college degree. It's a really unfortunate long-term investment error that I think we're going to be dealing with the ramifications of that for a long time.
Just a quick comment on that. There is definitely in the post-COVID era a real shift in work because, as you pointed out, roughly around half the jobs in the United States, you have to be on site to do it. You're right. You can't change your bedpan via Zoom. You can't be a waitress via Zoom, or a policeman via Zoom, um, etc. But a lot of information in office jobs you can do remotely, and we started doing remotely. We've had this big pushback about people wanting to go back to the office full time. And that kind of came to a head in two ways in the last month. Way one was Elon Musk, who's been adamant about getting rid of work from home, basically came out with this big announcement after he fired half of the Twitter workforce that you're free to work from home somewhere else, not here. He wants you there 5 days a week, to the point where the city of San Francisco is now looking into whether or not they're putting beds in the Twitter office because the people are not leaving, and that whether or not that's violating some kind of building codes by having people sleep in the offices. And in New York City, just this week, we now hear that the MTA, the Metropolitan Transit Authority, who runs
Yes.
the subway system, is now thinking about cutting back service on Mondays and Fridays because so much hybrid work. And of course, New York City is so dependent on the tax base of getting everybody back into the office 5 days a week that if the MTA is running up the white flag and just saying, look, we're just losing money on Mondays and Fridays because that has a materially lower ridership than every other day of the week because of hybrid work. And then they're going to feed into that self-fulfilling prophecy here where we'll cut back on service on Mondays and Fridays. And then that'll give employees another reason to say, I have to be hybrid. It's so much harder to get here on Mondays and Fridays, that they're validating that there's this major change. And part of that change is, you're right, you get the credential of going to college. Now you want an office job, but that really means 3 days in the office. That means 4 days at home, Friday, Saturday, Sunday, and then 2 other days as well. So there's been this gigantic shift in change in the workforce. And I don't think we are really quite fully grasping what that means. And I don't pretend that I do. And it might be a decade or more before we really get our head around what all of that means and whether or not that is skewing a lot of the data that we're looking at. Either way, maybe it's overstating inflation growth, maybe it's understating it. All I'm trying to say is we are using the same measures to measure the workforce, the labor market now that we did pre-pandemic or 10 years ago. And it's a vastly different place right now. And whether or not those measures are as accurate now as they were pre-pandemic is still an open question.
Yeah, again, I think that's spot on, and to me speaks to the challenges that we face in navigating this period in particular, right? People often refer to these things like a fourth turning component, et cetera, using the methodology or the narrative of Anil Howe. I'm less enamored of that exact terminology and that belief, but I do think that similar to the late 19th century, we're entering into a regime in which the traditional measurements increasingly lead us astray, right? If I were in the late 19th century, you would have seen, or if we were in the late 19th century, and actually I encourage people to go back and read things like the New York Times archives, you'll actually find that people were bemoaning the situation and saying, oh my gosh, well, look, there's so many fewer farm workers than there used to be, right? We're running the risk of not having enough farmers. We're going to run out of food, right? That type of nonsense permeates the turning points in history that these represent. John Maynard Keynes, you can dispute many of the things that he contributed and said, and your choice of focus is or belief system is, I think, going to meaningfully influence that. But one of the observations that he made in a paper called "The Economic Possibilities for Our Grandchildren" is just that simply work for survival purposes should increasingly become less important. And unfortunately, in the puritanical sense, more and more of our work product becomes what we would describe as luxuries, right? The little extra services that we can provide to each other. There's another theory that basically says, what billionaires have today, or millionaires it used to be, have today is what the rest of the world will have in another 20 to 30 years, right? Servants to do your laundry, to clean your house, etc. That used to be reserved for the great houses, as we saw with things like Downton Abbey. Now we all have servants. We call them dishwashers, washing machines, etc. My expectation is that we're moving towards that, but that creates an extraordinary amount of anxiety around that transition, right? What am I going to do? How does my purpose and existence cease to exist when the demand for macro analysts and portfolio managers disappears in the future, replaced by some form of AI? I don't actually believe that. in its entirety, in the same way that we've seen chess become actually more popular in many ways as it's been assisted by AI engines or chess engines, to use a less general term. We're actually seeing increased chess playing as the game has become more approachable, more innovative, and has been refreshed in a lot of ways. I think the same thing's going to happen in our economy, but the poor information that we receive in the process creates real risks when you increasingly centralize the decision making as it sits with somebody like Jay Powell. So I think it's pretty clearly laid out that you and I, first of all, you're very open to the argument that Powell is receiving improper data, right? That the data doesn't actually indicate what he thinks it indicates, and then it's entirely plausible that the street forecasts around a recession with high probability that the labor market might be actually quite a bit weaker than the data would suggest. Let's move to implications of that, right? Let's say Powell is wrong, but he doesn't see it. And for reasons similar to what we saw in 2021, he chooses to stay the path and hike rates into a significant slowdown. How does that impact markets in your view?
Now, I'm going to assume that when we say he's wrong, we're talking about he's hiking rates into a slowdown, as you just said. And that also assumes that inflation is also going to be coming down too, or are we talking more of a stagflation type of environment where the slowdown occurs, but the inflation rate stays persistently above 2%? Because I think both of those scenarios would lead to very different market results. So do you have any, how do you
To
want to
lay it out
define
very
this?
clearly, yeah. To address that head on before you formulate your response, my argument would be that we could very easily see metrics like CPI ex shelter, if he's truly focused on that, begin to retreat and actually move into deflationary conditions as the economy weakens. But the headline CPI, because of the lagging nature of OER, owner's equivalent rent, is almost certain not to respond, right? That can create conditions under which the Fed has cover to say, well, the data doesn't clearly say that this is occurring, right? So
Yeah,
that's my fear. Is just like they ignored it in 2021, they're going to ignore the turn in 2023.
right. Now, if that's indeed the case, I mean, let's start with markets, and I guess we'd have to start with the market that is most.
Jim, did I lose you?
No, did you lose me? I'm still here. Hopefully, hello, and
I think I lost you. I think I entered into a Wi-Fi dead spot.
okay, I'm still here. Hopefully that people can hear me, and I'll keep talking. Hopefully, I'm not talking to myself. Let's talk about the market that is closely associated with the Fed, and that is short-term interest rates. Short-term interest rates are going to be tied to the Fed. If Powell is making a mistake, he is going to keep short-term interest rates much higher for much longer than people think. The market kind of senses that, or that this is what the market believes is what's happening, which is why the yield curve is so inverted. Long-term interest rates are much lower than short-term interest rates. Long-term interest rates are trying to highlight the idea that there's going to be a big slowing in the economy and the Fed's got to reverse, but short-term interest rates are going to stay much higher. If that's the case, if the case you laid out, the economy slows and inflation comes down, and Powell is making a mistake, I suspect that the curve inversion will get a lot more extreme, as we go forward. That longer term interest rates will keep falling relative to short rates, and it will come out. I might add, if the mistake is, just to throw this out on the other side, the economy slows, but inflation doesn't in that more stagflationary environment, I think you could actually see the opposite with long-term rates, that they could start moving back up. And they would move back up on the idea that nominal growth will stay, which would be inflation plus real growth, even though real growth would be coming down, nominal growth would be staying higher. That would help to pull those interest rates up as well. That's if he's making that's if he's making a mistake.
So the question,
If he's not,
yeah, so
yeah.
it's interesting because I had a conversation with Warren Mosler, who, as you know, is kind of the father of modern monetary theory in terms of at least the theory, the concept behind it. And Warren's argument, and it's one unfortunately that I kind of agree with, is that perversely, by raising interest rates as aggressively as he had as we have, in an economy where debt to GDP is so high, that this has effectively created a dramatic fiscal transfer, not to lower income households, but to higher income households. Effectively, this is a massively regressive tax that reduces employment while subsidizing those who are capable of having the surplus to own treasuries. That certainly seems like what's playing out. And if anything, it actually creates the conditions I think that you're describing on the second part of it, which is that we end up seeing a belated response to cutting front rates, but perversely, that leads to long term rates ending at a much higher level than they otherwise would have. So, this is part of the reason that I've been such a vociferous critic of the Fed. I think, if anything, we're actually creating inflationary conditions with our behavior as compared to reducing them on a long term basis, right? On a short term basis, I actually think we're creating the risk of a very deep, very painful recession because we failed to embrace the changes that are required in the economy, as kind of you and I are both agreeing very well may be the case. But you're actually creating much worse long-term conditions. You're effectively moving the entire economy to a lower level of performance.
So let me turn it around and ask you the question, what if he's right? What if we are in an era that we are in persistently high inflation? And let's just define that as some number significantly above 2% is the long run inflation rate X a recession. Now, yeah, obviously, if you annihilate the economy, you can get the inflation rate down to 2% or something under that, but it only stays there to the extent that you're in recession and then it rebounds to some number above. So if he's right, Powell's argument has been 40% of the public doesn't own assets. They don't own a house. They don't have a portfolio. They are getting a negative real wage. That means that their wage, that 5% increase in their wages is less than the inflation rate. Every year they go to the grocery store or to this mall, they can buy less on a real basis than they did the year before. So his argument is we have to get this inflation rate back down under control. And if he's right and that there is a bit of more persistence to this inflation, how much should he be leaning on the economy to try and lower the unemployment rate or lower the inflation rate to benefit those 40%, even though the 60% that own assets, a home, a portfolio, will be screaming and yelling that they are losing money on their home and portfolio. Is he setting up, kind of a have and have not kind of environment? But what if he is right? What is the right policy to do then at that point?
Yeah, it's a great question. Um, First, obviously, I don't think he's right. Um, but if he is correct, I don't understand how addressing that problem, which one, the evidence would suggest it's not actually true because we're seeing the levels of wage income as a percentage of GDP near all-time lows. So driving unemployment, um, and by the way, corporate income is near record highs, right? So driving unemployment higher seems like it would negatively affect those individuals far more so than it would those who have significant reserves, to which we've now transferred much more income in the form of higher interest rates. So I just think his prescription is fundamentally wrong. The If he is correct that we are in an environment of structurally higher inflation because supply is incapable of meeting demand, again, I don't see how this is at all helpful because the evidence is very clear and it's being increasingly borne out that the shortages of homes, the shortages of supplies of copper, everything else, are negatively affected by hiking interest rates as compared to the investments that we should be making that would allow those shortages to be released and at the same time raise wages for those employees that you're highlighting are adversely affected. So I just, I think what he thinks he's doing is just repeating Volcker under the assumption that Volcker was right. Um, I just think that that's like it's just so deeply flawed that like I understand it in the historical context, but it feels deeply unimaginative to me.
Now, what if he's right about on the demand side? He gave a speech at Brookings at the end of November, and he pointed out that there's another statistic that the Fed is using is called excess retirement. That there's something like 3 million people that have retired more than the demographers would have guessed, all things being equal. So, why do we have this excess retirement? He cited two reasons. Reason one was health concerns. Long COVID and other issues are keeping people that would normally be in the workforce out of the workforce because of their immediate health concerns. And that is can be a big part of that 3 million people unretired. Okay, I understand that argument. But the second reason he gave was a big boom in the stock and housing markets, and people just made enough wealth that they didn't need to work anymore, so they quit. And his argument about why we are seeing wage growth is we've got so many people that have quit because their spiders went up, their home price went up, I don't need to work anymore, and that they quit. That's his argument, that has led to a shortage of workers, that has led to wage growth. And this to me flagged when he said that, this is why he seems to be going after the put argument, is that he doesn't want to see this continue to happen. Well, the Fed pivot, the stock market goes to 5,000, everybody's happy, and then the next thing they announce is they're just going to quit their job because they don't need to do this anymore. And that just exacerbates the excess retirement problem that we have. So what about on the demand side of the equation? Because I agree with you, he can't do anything about the supply side, nor as he said he would. The simple line we like to say is the Fed can't print ships, the Fed can't print oil, the Fed can't print people. But he can do something about the demand side of the equation. And if we've had too much QE, too much Fed puts, too much forward guidance, and excessive market returns, that people are basically cashing out of the economy because they've got enough now, that he can do something about. Or do you disagree with that argument?
So I'd say two components, right? One is the evidence of labor force participation rates amongst those 65 plus would suggest that that's actually untrue, right? We've actually seen rising rates of labor force participation amongst those 65 plus that momentarily retreated once we introduced a dramatic health risk into the economy. Not long COVID. I think the whole long COVID thing is total crap. What I do think is a very real dynamic is if you are a 65-year-old, you no longer want to work in a customer facing role because of the risks of contracting a disease that, due to your individual risk factors, are much higher. Likewise, obesity within the American population is contributing to dynamics where people are increasingly scared to enter into an employment relationship that puts them into a customer facing role. So I would argue that the much more dramatic risk is for many of the lower income jobs that put you into direct contact with other individuals, the tangible risks have increased, lowering supply, right? The costs of going to work are higher. Likewise, higher gasoline prices, higher costs of all sorts of services, et cetera, encourage people to ultimately move to a lower consumption node earlier on. Secondly, as you pointed out, the vast majority of people actually don't own assets. So the entire argument, in my view, is specious, right? Like, why would you want to hit the retirement capability of people through the asset channel when you're saying that the majority of those individuals really that's not their source of retirement? It's largely through things like Social Security. The third component that I would highlight on exactly this issue is that the decision to do something like that being made by a single individual who was contested within his own organization, to have given that individual power to that level to make that type of assertion without absolute certainty in an economy as large and dynamic as the United States is, in my opinion, criminal. And if that's actually his reason, if he thinks it's his right to say people shouldn't have the opportunity to retire, he should be thrown in jail.
He was given, to defend him and get you to react to this. In June, he went to the White House when we had 9% inflation and $5 gas, and the president of the United States pointed to him and said, it's his job to fix the inflation problem, and he's going to fix the inflation problem. He was given a mandate by the president of the United States in June, Jay, do something about inflation. And he's doing something about inflation. We might not like what he's doing, but he was told to deal with this problem straight on by the
By the way, I
president.
completely agree. He's got the get out of jail free card. That means he won't go to prison. But what he should have said to the president is, there's nothing I can do, Mr. President.
You know,
You
um,
created the situation with your excess spending. You fix it. It's not my job. That's
I
not my
agree.
mandate.
He should have said that, but he
But he
took
didn't.
that mandate. He took that
Right.
mandate and he
So
ran with
so
it, and
let's
he's running
let's
with
let
it.
him correct. So let's let the responsibility sit with him where it resides. Let's not give him the out by saying he was told to do so by the president of the United States. The entire point of the political independence of the Fed is he should have said, Mr. President, that can't be done. He
I
chose not to do that.
Right, he did. He did choose not to do that, and this kind of falls into this kind of nebulous area that I always, try to straddle too between what should he do, and I kind of view my job as much as forget what he should do. I'm telling you what he will do, and I'm telling you why he's doing it.
Yep.
And so he
Agreed.
was given this mandate by the president, and this is the way he thinks. And we could argue he's wrong, but he ain't going to change until we get the parameters that he needs to change along the way. And there are ways to fix this. I think one of the ways to fix this is that if we had a more independent minded Federal Reserve, that we had if you're a Fed governor or a Fed president, you are appointed. Take Fed governor. You are appointed by the Senate to represent the American people. But too many Fed governors think that their boss is Jay Powell. Their boss is not Jay Powell. Their boss is the American people. And there should be a little bit more independence. The last Fed governor to dissent was Mark Olson in 2005. We're going on 17 years without a single dissent from all the Fed governors. Could you imagine what the country would feel like if somebody said, as an associate justice of the Supreme Court, my boss is the Chief Justice of the Supreme Court, John Roberts, and I will do what he tells me to do? How upset people would be about that? Well, that's the way the Fed works. And the Fed should work more like the Supreme Court. The Supreme Court has 5-4 votes all the time. They're still the law of the land. Why can't the Fed have a 7-5 vote for monetary policy? They at the Fed have decided that somehow that would reduce the effectiveness of monetary policy. So the way the Fed works is, as a Fed governor, I can make space on Jay Powell's calendar and I can go into his office and I can explain to him why he's making a mistake and be sarcastic about it. He'll put on his very serious, I'm concerned and thank you for your speech face, but then he'll walk into the room and he'll do whatever he wants, and you're expected to validate it by voting for it. Why don't we stop that? Why don't we start seeing 8-4 and 7-5 votes? Or maybe a Fed governor or a Fed chairman loses a vote along the way because the rest of the board doesn't want to do what he does. That is never. I don't even recall the last time, if there's ever been an example of a vote, of a formal vote. The Fed governor or the Fed chairman voting against something that lost. But we don't think of the Fed that way. So this is why we've invested way too much power in one person, and that's the fix to getting rid of it. But that I just told you what the fix is. It doesn't mean it's going to happen anytime in our
Yeah,
lifetime.
no, I think this is actually, I mean, where we're coming, it feels to me. By the way, I think he's under. There's a book by Mark Spindell called "The Myth of Independence: How Congress Governs the Federal Reserve," that does a wonderful job of articulating everything you just said. Right. I would encourage people to read all 296 pages. Actually, you don't have to do that. You can. It is a great book, and I really do encourage people to read it. I think it's criminally underread, but the recognition that what we're watching is a game of politics as compared to a game of economics, I think is actually quite important. And so we tend to think that the Fed is doing what it's doing because they know more or they have insight. Um, I don't think that's the case at all. I think in this situation, the intentions are generally good, right? They actually believe what they're doing for the most part. Certainly, Powell, I don't think, has the intention of driving the US to a lower economic node and weakening our economy in a way that meaningfully negatively affects the future opportunities for our children. But I do think he is doing that. Um, and I do think that there will be ramifications eventually associated with it. The irony is he thinks he's playing Volcker. The reality is he's playing Burns. Um,
You, just real quick, when you talk about the politics of the Fed, there's no better example, recent example, than what happened with Judy Shelton.
yep,
Judy Shelton was a heterodox opinion. Okay, whether or not you agree with her interpretation of the gold standard is really kind of irrelevant. She just had a different opinion, an outside the box opinion. She would have been one of 19 people on the Federal Reserve. She could have gotten voted down 11-1 all day long if she was voting for things that they didn't want to do. But the institution itself could not handle one heterodox opinion. So, as the New York Sun is pointed out, Jay Powell was politically working behind the scenes, calling people like Senator Romney and Senator Murkowski to make sure that her nomination failed when it went up to the Senate for a vote in December of 2020. To me, that was so telling about the organization itself that
totally agree.
somehow they felt like one outside the box opinion, even if you agree it was wrong, it couldn't handle it. It couldn't handle it at all. They needed to make sure everybody was in line. And so, Jay is a creature of the institution that he heads right now. It's more than just, oh, if we just got rid of Jay Powell and we put the right person in charge, they're still going to wind up, having way too much power. They're going to still wind up, we're going to be relying on somebody to be some kind of oracle that's going to be able to see around corners and get everything right, as opposed to the original purpose of this organization, which has kind of lost its way.
Yeah, I unfortunately I completely agree with that assessment, and would go maybe even a step further and highlight that because disagreement cannot be expressed within the committee votes, it gets played out effectively as a Game of Thrones on succession, right? For those who have watched the HBO series Succession, you see the children effectively plotting with each other and saying, "Oh, I totally agree with Dad," unless you think something else, right? That's effectively what's playing out, right? We're watching Lael Brainerd agree in committee, disagree in public, positioning herself as basically the person who didn't follow this policy, even as she followed this policy. Jim Bullard is trying to position himself for a position that he has no real ability to occupy, in my opinion, by basically saying, "Oh yeah, no, I'm going to toe the line, but I'm not going to be quite as extreme as Powell." Right? He's going to be the centrist choice because nobody really likes Lael. It's extraordinary to watch once you put on your Game of Thrones hat to recognize that they're all maneuvering for the ultimate prize, which is position, as compared to making things better for the American public. It's distressing as a market participant. It's distressing as a parent to watch us choose to make what I think are meaningful errors that are likely to move us to a lower economic node. Um, but it's also endlessly fascinating, right? It's we've got our own episode of Game of Thrones.
Right. Mike, I got about 10 or 15 minminutes left before I
I
have to
was I was
leave.
I actually have to do the exact same. So what I was going to do is open it up for a few questions, and then let's wrap this up. I would very much appreciate any questions that are coming in to be on point and respectful. Our first question looks like monetive wealth. Let's ask them to join us for a quick question. We're going to limit it to make sure we're respectful of Jim's time. We've already taken about 80 minutes of it. Monative, go for it.
Hey, thanks, guys. Really appreciate you letting me speak. I just want to make some comments about what was expressed earlier about job cuts in Twitter and how tech companies could cut 50%. Uh, you know, I. I I keep hearing this in spaces a lot, and I think it's a meaningless argument. I apologize. I'm not trying to be rude, but I've been in the valley for over 20 years, and I work deeply with these companies. I've been, part of many of these organizations. Deep cuts are possible, certainly in exceptional cases, and Twitter has shown that. But anything of that size is not going to be without significant impact to the future of the company itself. So the likelihood of anything more than a teens level cut in a successful company is just out of question, and it's just not even possible now.
So let me pause you there for a second because I think your observation is actually both interesting and important, but I don't want to let it go on too long. It actually doesn't matter. What matters is that the narrative has now changed, right? And in the same way that we've seen employers hoard employees at the expense of productivity on a 22 year to date because the narrative has been the labor market is so strong, Elon Musk and others are beginning to open up the narrative to we don't need these guys. Now, whether that ends up being true or not, I would argue is actually irrelevant to the discussion. The narrative is in play and the job cuts are coming. Jim, do you want to comment there?
Yeah, and I would say just to follow up on the narrative, I think what Musk's narrative is look at what he's been saying about trying to find a successor. I need Twitter to be profitable now. Now, I don't need Twitter to scale into the future to be sold or to have a higher valuation. I need a profit now. I need my expenses less than my revenues now. And what's your big expense? It's people. And how do you get that? How do you get to be profitable now? You have to let people go. And I think that narrative has changed in Silicon Valley right now. There used to be a narrative in Silicon Valley that you were doing something wrong if you made a profit, because then you would make an expectation that you'd had to continue to have a profit. It would stifle your ability to scale in the future. I think that narrative is changing. So that's why you're hearing all this talk about we need to have mass layoffs in Silicon Valley.
I totally agree. All right, let's hear a question from Running Man.
Hey, thanks for taking the question. Mike, I just had a question about your tweet yesterday where you had some of your outlooks, and I think the thing that caught my attention was 2-year being the best performing asset. So I guess I just wanted to ask a little if you could talk a little bit more about that. Is that more of obviously yields going down and the rest of the market not doing well? And then I'm not sure if you're allowed to comment on this, but I really intrigued by FIG and just kind of tracking your positions on that. Are you allowed to comment on like what your expectation is for FIG or no?
Well, I certainly can't comment on the expectation, but FIG is the one product that is run directly in a manner that basically reflects my allocation. And so within that, you'll actually see that I hold a position in the strategy we offer from Simplify that's roughly a 5 times levered 2-year. It's one of the largest individual positions, certainly from an economic or volatility impact. It's going to be one of the largest contributors to performance. And so very much reflects that point of view. Although I want to be very clear that list, I should have been clearer in posting it, is actually Mike Taylor's list. That happens to be a point of agreement between the two of us. So that that outlook was in the same way I retweeted Jim's tweet thread today is not necessarily what I was highlighting. Although I will tell you that Mike Taylor is infinitely more talented in this business than I am. So I would encourage you to take that tweet at face value as a very valuable and insightful list, but that's not directly mine.
Oh, that's Mike. That's Mike as in Mike Taylor, not Mike as in Mike
Correct.
Green. Oh,
Right.
okay.
Yeah, Mike Green, nobody wants to hear about. That's
And
totally
then
fine.
what? Maybe just back on FIG. Would you consider that like a moderate risk target, like a 60-40 type vol, or can you
So
comment on that?
yeah. So the objective in that strategy is to behave similarly to a 60-40 portfolio in an environment in which 60-40 is increasingly challenged.
Got it.
We've been fortunate on a year-to-date basis to outperform the benchmark there with significantly less volatility. I'll just lay it out there very simply that the orientation of that portfolio right now has much lower equity exposure, much higher fixed income exposure, reflecting exactly that articulation that I think the 2-year is a really attractive place to be. As this call should make very clear, I am actually very much in agreement with Jim that the intention of the Fed is to increase rates and keep them high. Unfortunately, I think that the economic signals that we're going to get as a result of those errors, which should be fairly clear by now, I think that they are distinct errors, are going to force the Fed to move in the opposite direction, interjecting significant volatility. And I'd highlight a tweet I put out yesterday around a curve steepener, which I actually think is going to be one of the real trades for 2023, is as the Fed is forced to recognize its mistakes in 2023 in the same way it was forced to recognize its mistakes from 2021 belatedly, the curve could steepen dramatically, exactly as Jim was articulating, that the 10 and 30 year don't fully participate and offer the protection the duration has historically provided because the Fed has managed to screw things up royally.
Great. Thank you so much. I appreciate it.
My pleasure. All right.
If I could just interject, I
Yep,
agree
please
that
do.
in the fixed income space, I think that my highest conviction idea would also be a curve steepener from here on forward, because you're going to get a curve steepener one of two ways. Way one is, let's say the economy stays strong in the first half of the year and all hope of a Fed pivot is dashed. You could see long rates go up and that steepens the curve. Or way two is the economy severely weakens and you see short rates go down because you see them really price in an actual pivot is coming. I like the steepener because you win two ways as opposed to a duration trade where you basically only win in one direction. So the steepener, or to put it in a different light, 18 months, 2 years ago, the 2-year, 10-year curve was positive 300 basis points. It's now minus 75 or 80. Oh, I think you might see minus 100 and get your red headline on Bloomberg. But what I just said is it's 90% done. It might be 95% done, the curve flattening. It still might linger on a little bit longer for a month or two or so, but the next big move, I think, is going to be steepener one way or the other.
Okay, fantastic. All right, let's jump to the next quick request. Jim, you got 1 minute, and I really appreciate it. Let's see here. All right, guys, I'm going to take a risk. Macro Mindcap, who has crypto in his description, has requested, and he's been patient. I'm going to let him speak. Hopefully, I'm not making an error here in bringing up a crypto view. MMC, you can ask your question.
Yeah, hi guys. Thanks for this this call today. So one of the calls that I was on recently, or Twitter Spaces with Mike Green, was with Mike Taylor, and referencing one of the things that he said. And I'm wondering both your thoughts on this, where he was saying that Powell, to Jim's point, is going to go as far as he can until he either breaks something or something needs to change, or the markets make him change. That being said, one of the things Mike Taylor said is that he has to kick the can down the road. Essentially, he has to reload monetary policy in order to eventually be able to push rates back down and keep all of the legacy system in place. Otherwise, we have to kind of pivot and go towards this different world, which I'm unsure of. But can you just speak to that and what you got from Mike Taylor's comments related to keeping the legacy system going and what Powell's doing to keep that can kicked? Thank you.
Can I request, actually, since we got to be respectful of Jim's time, let's let Jim go because I don't think Jim wants to comment on Mike Taylor's view. And I'll try to answer that question after we've allowed Jim to hop off the space, and then I'm going to conclude the space as well. So Jim, if it's okay with you, let's end there. This has been phenomenal. I cannot thank you enough for both putting out that tweet thread that stimulated a lot of thought for myself as well as this discussion. And I encourage everybody to check out Jim's both research, follow him on Twitter, and recognize that he's one of the voices that I really deeply appreciate, both for his insight into the Fed as well as his thoughts on the economy. In this situation, Jim, not to fully speak for you, but I think you've done an amazing job of articulating exactly what Powell is seeing and how he's likely to respond. I think this has been one of the big confusions that we've seen on Twitter is disagreements that seem to be about Fed behavior are often disagreements about the underlying economic conditions. This was a great space, I think, in ironing out some of those components. Does that feel fair to you?
Yeah, I agree, and thank you for those kind words. That there really is, like I said, I think what's important is how does Powell look at it, and how is Powell going to react to it, and what is Powell going to do? And I can stand here in the corner and do jumping jacks that the economy is going to do something else and it's going to be worse and everything else. Well, if Powell doesn't respond to that, and we are in the business of talking about which way asset prices are going to respond, we're going to be hurt. We're going to be hurt real bad, as people were in 21. They're going to pause. They're going to pivot. They're going to step down. They're going to do all of this. And every time that happened, people got excited that here comes the big rally, and then Powell would continually throw hot water on it, or cold water, a better analogy. And I think that going into early 23, it's the same thing. We've got the market thinking one way, and maybe the market is looking at the data and concluding something, but the market isn't saying, but there's one very powerful guy in charge, and he thinks differently about this, and he's going to react differently about this. And we got to start thinking about how he's going to react to this, not what does the data, how he's going to react to the data, not what we think the data is going to say. So it's going to make for a very exciting 23, at least the beginning of 23, as we continue this. And thank you, Mike.
Totally agree.
And thank you,
Jim,
everybody.
thank you so much. I'll let you go, and then I'll try to hit MMC's question.
Okay, thank you, and bye-bye.
Take care. Okay, that was awesome. As I've indicated, I'm opening up these Twitter spaces. I always do calls like this as we approach the change of the new year to individuals that I really respect their insights. In particular, I'm seeking people that have a different point of view to me. MMC hit on a point of disagreement between Mike Taylor and myself. Mike is very much of the view that what the Fed is really trying to do is to establish continued demand for treasuries, recognizing that the issuance of treasuries is likely to rise significantly, and that the rest of the world is increasingly facing a choice: do we invest in the United States or do we not? Where I disagree with Mike is I think so first of all, Mike actually thinks, like I do, that the 2 year is likely to be the best performer because he really actually thinks that Powell is done. There may be one more hike, but if that's the case, that the implications are potentially even worse. Where Mike and I kind of agree is whether the Fed should pause and stay at this level now that it's gotten to this level. Mike's point is if the Fed were to reverse on the first sign of a weak payroll, et cetera, that would effectively reinforce the dynamics of the Fed and put us into a condition where there was no longer any risk that the Fed would not respond, right? So in many cases, in many ways, that would exacerbate the conditions that led to the Fed's choices or the Fed's need to behave in this way in the first place. My concern is that we've gone so far so fast that with zero consideration for whether the data that we're receiving is accurate or not, that the Fed has moved us to a much lower node. Mike actually concedes that that could very well be the case. He simply is saying, look, if the Fed behaves with increasing volatility around these components, that we're going to further destroy and damage the credibility of the institution. So I unfortunately think that part of what Mike is saying is very correct. Having made the mistake, we now probably have to live with it. Um, my fear is that the Fed doesn't understand the forces that they're actually dealing with. And I think I've made that very clear in my dissection of the data that they're looking at. That has important ramifications for asset markets, but it's a subject for discussion at a future date. Did that answer your question, MMC?
Yes, thank you.
All right, perfect. All right, I'm going to take Gordon Johnson for one more question, and then I'm going to end the spaces as well. Really appreciate everybody joining and participating. It's incredibly flattering to have 1,300 people show up and pay attention to nonsense ramblings and discussions. So really appreciate it, and again, encourage everybody to follow Jim Bianco and any of the other thoughtful speakers that you've heard come up. I think this has been a great space. Gordon, go ahead. Gordon, I can't hear you. Gordon? Oh, this is going to be so anticlimactic if we lose our last speaker. Wouldn't be a Twitter Spaces without a disruption. Is it at my end or is it at others? Can anyone else hear Gordon? Simplify, can you hear something? Okay, Gordon just dropped out. All right. Well, that's a shame. Oh, he's back. Okay, let's let him try one more time. Gordon, welcome. Unmute yourself and ask a question. Gordon, you got to unmute yourself.
Hey, Mike. Thanks for bringing me in. This was a fascinating discussion. I'm sorry if I dropped off there. I had a call. I had to.
That's okay.
Yeah.
Don't worry about it in the
I
list.
apologize. I had a call. I had to take. Just wanted to ask a real quick question. You know, you and I have had some heated debates on I think some of these topics. But I think your argument is that what the Fed is doing on rates is too much. Is that accurate?
I think that what the Fed is doing on rates is too much. Correct.
Okay. And by the way, Mike, you know, I love your stuff. You do phenomenal work. But I guess the question I have is, I guess there's three key things that, in my view, drive inflation, and those three key things consist of essentially um, uh, wealth, um, basically the amount of credit in the system, and wages, wage growth. And if you look at all three of those things currently, all three of those things are currently at levels that are indicative of increased inflation. Um, and when you consider that, you consider, you know, the Fed did, you know, the first 100 years of the Fed, you know, the balance sheet grew by 980 billion. They did 3 trillion in 2 months in 2020. So they did 300 years of balance sheet expansion in 2 months. And then they urged Congress to join in the spending orgy, and Congress did. And, you know, people blame Congress, but, you know, the Fed, you know, Congress can't spend if the Fed doesn't print. So really, all these spending bills are being funded by, you know, the Fed counterfeiting, if you will, U.S. dollars. So when you consider all those things, like, how can you conclude that, you know, what they're doing is too much when the Fed funds rate is currently sitting at, you know, below, what is it, below 5%, whereas inflation's at 7.1, and those three key indicators are hinting at, you know, continued inflation, with the job market still, way too strong to indicate we're in any type of recession. Thanks for the time.
Yeah, so I mean that's actually the point of the data that I showed. I think uh, the formulation that people often use, where they use the Fed funds rate or current interest rate compared against current levels of inflation, is actually mixing time periods. Inflation, as you're reporting it at the 7% level, is what happened over the last year, whereas interest rates are what's happening in the future. Inflation expectations are well below the Fed funds rate. If I actually look at inflation expectations on a break even or even in surveys increasingly for 2023, it would suggest that we're facing a significantly positive real rate which actually is counterproductive to the investments that I think need to take place for many of the changes that Jim and I both articulated. The second is I think that the data that the Fed is receiving in terms of the strength of the labor market is fundamentally misplaced. I think part of what we've seen is the dynamic of hoarding labor. That narrative is now shifted, as you heard me refer to, and I think that if anything, we're going to see an acceleration in the data towards layoffs and reductions. I highlighted the dynamics of the misleading components of the non-farm payroll and the um, reporting of jobless claims tied from the individual states tied to the dynamics of who is eligible and the attempts at reducing corruption by disputing claims. So I just think the data that you're receiving, that you're referring to, is flawed. I would also highlight that I just disagree with the methodology of using a trailing inflation rate versus a forward component. On the last dynamic in terms of wages, ultimately that has several different drivers to it, part of which is composition. So when you think about metrics like the Atlanta Fed that track median wages, the median is disproportionately affected actually by what's happening at the lower end of the economy. There's no question that there is a shortage of tradespeople, that there is a shortage of individuals who are willing to get their hands dirty. I alluded to that before. In particular, that's tied to the reduction of immigration. We have no plausible solution for that directly ahead of us, other than to start training people and to start recognizing that that is a fundamental mistake to focus in an economy on the credentialism associated with the goal being to obtain a college degree rather than to obtain useful skills. It takes time to fix these mistakes. And hiking interest rates in the manner that we're doing does nothing to actually address those fundamental problems. It simply kicks the can down the road and exacerbates it in the future because we're not actually changing any of that. If anything, we're leading to conditions under which people are less willing to participate in the economy, more willing to suspend their participation by heading off to college and taking subsidized student loans that pay for half of which go to pay for living expenses. It's really easy to convince an 18-year-old to do that, at least under the historical framework. We're seeing some evidence that that's changing, although I would argue that reduced college admissions is largely a function of decreased demographics and decreased immigration in terms of students coming over from places like China. So I just fundamentally disagree with one, your interpretation of events and the historical data, and two, the actual data that we're experiencing today. I don't think represents the strength that you're highlighting.
Can I address that, Mike? Just real quick. So
I don't, yeah, Gordon, I'm not sure that this is the right place to do it. I'm happy to take the conversation offline.
no, I just have one last question for you.
Sure, please.
So when the Fed did 300 years of balance sheet expansion in 2 months, right, in 2020, right, the idea was they're doing that to help the economy, right? But if you look at retail sales, right, the trend there, right, we were back above the trend line within 6 months. Yet they continued to do this very aggressive QE and urge Congress to continue spending. Were you sounding the alarm back then when they were creating all this artificial demand with this money printing?
Absolutely.
Okay. Because the only thing they can do, right, is control demand. So, if they're going to fight inflation,
that's actually not true. Again,
okay,
going back to what I said, when President Biden said you have to do something about inflation, he should have turned around and pointed his finger, and recognizing the four fingers point back at him when he does so, and say, no, this is your job. You fucked it up.
But the government can't do these spending bills if the Fed doesn't print the money to buy their bonds. So effectively, when they do these spending bills, it's effectively Fed stimulus.
That's just not true, right? You could actually allow the market forces to prevail. If the government tried to overspend, you would see a significant increase in the rates associated with that.
How does the government issue trillions of dollars? How does the government do these $1 trillion spending bills without the Fed printing money?
By discounting their bills, offering people an attractive return by buying into that risk-free component.
Okay, I fundamentally disagree with that.
Right, is how the market. But that's just not true, Gordon. Right? Would the market find a buyer for those if they were at 19%? Yes. Would that cause the government to rethink its spending priorities? Probably.
When has that ever happened? That's never happened. The government has never done a massive spending bill without the Fed printing money.
What you just pointed out is first of all, that's again not true. But secondly, the point that you made.
When has it happened?
That the Fed. When has the government had significant increases in spending without the Fed printing?
When has the government done $1 trillion or $500 billion spending bill without the Fed printing money?
When has the government done a $500 billion discretionary spending bill prior to this event?
No. What I am suggesting, which I think is proven by facts, is that the government can't do these large 500 billion slash $1 trillion
You're
spending
making
bills
a
without the
statement,
Fed
Gordon.
printing money.
You're making us. This is one. This is not the place. But two, you're making a statement about a counterfactual that you have no evidence for. We don't know what would have happened if the Fed had not decided to print money. We don't know. We don't have that counterfactual available to us. My expectation is that it would have led to a significant increase in the interest rates that the U.S. government had to pay, and we would have possibly recognized the error of our ways. I'm not disputing that the Fed shouldn't have enabled much of the spending that occurred in 2021 in particular. I do think it was really important that the Fed stepped in once the fundamental error of the stupidity of shutting down your economy in response to an airborne virus in March of 2020 was actually entered into. Right. Once the government made that choice, I believe that the Fed had no choice to respond to it. But to continue those policies, I agree with you, it was an error.
No, but
That's
I
not.
guess
But two
I'll
wrongs don't
say
make a
this one
right.
last comment and I'll
Two
leave it
wrongs
here.
don't make a right.
What I am saying is that there is not global demand sufficient for $500 billion of U.S. government spending, barring the Fed printing money to buy the majority of those bonds. That is what I am saying.
And I'm suggesting that you don't have a counterfactual with which to make that statement.
I could address that, but it sounds like you want to leave it there. I would just say that,
Yeah,
can you show me a case when
I
they've
think
done
we
one of
do.
these
I
large
think.
spending bills that the Fed has not printed money? That's my counterfactual.
Can you show me a case in which December 21st, 2022 has emerged before?
I'm sorry, what was that?
Can you show me a case in which December 21st, 2022 has emerged before? Every day is a different day. We don't know what happens in the future. We can't speak to counterfactuals. That's part of the reason why economics is not a science in the traditional dynamic. You do not have repeatable or controllable experiments. The arrogance with which the Fed is approaching this challenge, and candidly, I'd say the arrogance with which you're approaching the statement of your assertions, is, in my opinion, part of the
But
challenge.
I don't understand why
Right?
you
We
call
don't
me
know.
arrogant. I'm asking you to show me an example
You're
when
saying
the Fed
something
has
can't.
done
You're
one of
saying
these, when the
something. You're
government has
saying
done one of
something.
these spending bills, that they've done it without the Fed buying the bulk of the bonds that they print to fund the
Again,
spending.
there is no precedent for anything, right? There is no precedent for anything, and even if there were, it's not a repeatable and controllable experiment. That
So
is
you
actually the
agree with
key
me
point
that
that I
the
really want
government
people
has
to take
never
away.
done one of these large spending bills historically
The government has never
without the
done
Fed
500. I know what I'm
printing
actually
money.
saying. There is no without. You're placing a constraint on this. Without the Fed is an unnecessary part of that statement. The government has never done that before. The government has never shut down the economy in the manner that it did. The minute you start doing things that have
Well, no,
never
they did
happened
it in
before, the
2008
ability
9
to,
when we had the global financial crisis. They did these massive spending bills funded by the Fed printing money.
and we got what inflation?
We got massive inflation in the things that it was monetary stimulus. It wasn't fiscal. We got inflation in stocks and we got inflation in houses. That's where the inflation
All
was
right,
seen.
okay, Gordon, let's have this discussion offline. This is somewhat absurd, right? I don't think you're actually understanding the point that I'm making, which is you can't make those sorts of assertions. You just simply can't say the Fed has never and can't do something, right? Because you don't actually have that counterfactual. I do
That's not what
actually.
I'm
The reason
saying.
I'm,
What I'm
I'm
trying to say
continuing
is
this
that
to
the
say no.
government can't do these massive printing bills without the Fed printing. So, thus, these massive fiscal spending bills are in effect Fed stimulus. That's what I'm saying here.
Yeah. Again, I don't think you can make that statement. Let's pause it there. I've got Mike Taylor burning up my phone on the other side saying, oh my God, let me go after Gordon. I'm not going to let that happen. That would allow the space to degrade. Gordon, I appreciate your thoughts. I really do. This has been a phenomenal space with a dramatic conclusion to it. I'm on a call tomorrow with Mike Howell. That's actually going to be a fantastic discussion. Cross-border capital is probably one of the leaders in thinking about the dynamics, some of which Gordon is alluding to around the impact of liquidity. It's going to be at 7 a.m. tomorrow. I really look forward to people joining me. And thank you very much again for the support, participation. This has been another phenomenal space. And again, I encourage people to pay attention to everybody on this group. Thank you very much. We're going to end it here.